on Inside the Issues, I speak with David Kempthorne on progress in international economic governance. Hello and welcome to this week's edition of Inside the Issues, a CIGI online podcast. I'm David Welch, CIGI Chair of Global Security at the Balsley School of International Affairs and Senior Fellow here at the Center for International Governance Innovation. And it's my pleasure every week to welcome a guest into the studios at CIGI to discuss some important issue on the international agenda. And today I'm very pleased to welcome David Kempthorne, who is a research fellow in the Global Economy program here at CIGI and a co-author of an important recent policy brief and a participant in a major project on international economic governance. So welcome, David.
Thank you.
Welcome back, I should say. Let's begin by talking about this project you're doing, and in particular, a very interesting survey that CIGI does each year to gauge progress on international economic governance. Tell us what that's all about.
So it's a survey that we do annually, and the intention of the survey is to assess the level of progress that has been made in facilitating economic cooperation between states, focusing on the extent to which the G20 and other key international economic governance institutions have facilitated cooperation. And this year we sent it out to 21 of our fellows who provide a quantitative and qualitative assessment of the extent of progress that has been made. And the key finding from this year was that uneven economic growth, predominantly the issues surrounding the Eurozone, is a key risk to the currently fragile global economic recovery.
And which dimensions of international economic governance are you particularly concerned with at the moment?
So a key issue and a key concern was macroeconomic and financial cooperation. And the key issue that arose there was that the issues surrounding the Eurozone and the slow rate of return to growth, continuing issues around deflationary pressures in the Eurozone are having a real impact on the extent and the confidence of the global economic recovery. Now, what this highlights is that countries in Europe have failed to cooperate in their macroeconomic policies. Critically, those countries who have fiscal room to pursue expansionary policies that would stimulate consumption and stimulate growth are not doing so and continuing to consolidate their fiscal portfolio and public finances. Now, the issue with this is that those countries and those economies in the south of Europe who are struggling to consolidate their finances and public books, who need economic growth to achieve that, continually get themselves into trouble. And the inability to grow themselves out of public debt is a persistent issue within the Eurozone.
So what are the main cleavages here in Europe in particular? Is it a Northern Europe, Southern Europe split? Is it a France-Germany split? Mm-hmm. Is it a Britain versus everybody else split? What are the main dimensions of this lack of cooperation?
The main cleavages are between Northern Europe and Southern Europe. Countries such as Germany and Netherlands, who have always pursued conservative fiscal policies and have maintained conservative fiscal policies throughout the crisis, are unwilling to relent in allowing those countries in southern regions to pursue expansionary fiscal policies that would stimulate growth and become an engine for growth that would get them out of this current malaise.
And what's the argument against them doing that?
Well, the argument against that is that what we need right now is consolidation for governments to reduce their total level expenditure and increase taxes to reduce the amount of debt that they have. Now, the problem, as we saw in Italy, is that when you consolidate your public finances, you try and reduce the amount of spending and increase taxes. The rate of economic growth slows down. Now, when the rate of economic growth slows down, so do the revenues coming into the government. Now, the impact of this in Italy was that despite the fact that it reduced its total level of spending, it actually declined in terms of economic growth, which meant that its level of public debt as a percentage was higher. Now, what this shows is that Europe needs pro-growth policies. It needs policies that will encourage employment, that will kickstart the European economy again, and we're just not seeing it. And it's an issue of politics. The northern economies are just unwilling to allow those in the south to expand, yet they themselves aren't willing to be that engine of growth going forward. And so it's a classic cooperation problem.
So how would that happen in practice? If you wanted the economies in Southern Europe to expand, if you're a country in the North whose economy is in relatively good shape, what exactly would you be doing to have that happen?
Essentially, we'd like to see northern economies adopt an expansionary stance for their fiscal policies to encourage further investment, further employment, and further economic growth. And doing that would require them to increase their levels of spending relative to the level of revenues coming in. And doing that would provide an opportunity for the euro economy to grow as a whole and for southern economies to benefit from that. And that economic growth would ease the pressure on the fiscal stance of southern economies.
So it would be allowing Northern European debt to rise so that Southern European debt could decline.
Essentially, though we wouldn't put it in those terms because we don't know what the impact will be on the total level of debt.
Right.
Because the expansion of the Eurozone as a whole should facilitate greater government revenues across the board. Now, the other part of this issue, which is important, is the monetary policy of the ECB. A number of people in this year's survey commented that the ECB's monetary policy stance was relatively conservative compared to those of other countries, and that their reactions to the crisis has been relatively slow. Now, this is surrounding quantitative easing. Essentially, the ECB would expand the liability side of its balance sheet to inject money into the wider European system, as well as policies that would be directly targeted at the European financial system, which would ease credit conditions across Europe. And this has been a key difference between the return to economic growth of the United States and the issues that are facing Europe. Essentially, Europe didn't respond aggressively enough, and it didn't do so because there are a number of members in Europe who are against quantitative easing policies.
Now, the ECB today is different from the ECB at the height of the crisis. It's been strengthened. It's been given more of a real central bank kind of role than it used to have. Is that generally considered a success? Is that a marker of progress in economic governance in Europe, according to your survey respondents?
It is, but we felt that it didn't go far enough. It's an interrelated issue with the fiscal policies that I discussed before. Essentially, the lack of fiscal stimulation in Europe has placed too much of a burden on monetary policy within the ECB. Now, as you said, the ECB has been relatively strengthened in the sense that it has been given the power to implement quantitative easing and targeted asset purchase programs, which will facilitate and ease credit conditions in Europe. But it hasn't done enough. It could be more aggressive. It hasn't instituted policies to the extent and to the level that major central banks such as the Federal Reserve and the Bank of England did pursue at the height of the crisis, as well as ongoing through this economic recovery. So, in comparison to other central banks, the ECB remains relatively conservative, and we feel that it's not doing enough.
So it's not a question of a lack of capacity at this point, it's a question of lack of will.
It is about a lack of will. Without being an expert on the topic, I know that the ECB has been empowered a little bit more, but in terms of having the confidence to use the quantitative easing and credit easing powers that it has been given, it doesn't have that confidence. And there's a lack of will by the central bankers who sit on the ECB.
Now, what about the euro itself? Back at the height of the Greek crisis in particular, there was a lot of speculation that Greece might leave the eurozone, which of course would be one relatively easy quick fix for its problems. If it could have a currency that would devalue quickly, then it could easily grow itself through exports out of its problem. People aren't talking about that anymore.
No.
Does that mean that people have high confidence in the stability of the eurozone now, that there's no real risk anymore of the eurozone falling apart, or?
Well, tentatively, yes. There has been some progress in terms of a sense of confidence in the euro as a currency. Importantly, there have been some measures introduced to strengthen the coordination for the resolution of financial firms, for instance, for strengthening cooperation on the supervision of financial markets, as well as coordination and cooperation of of fiscal measures which would reduce the willingness of Europe to accept the level of fiscal deficits that we saw before the crisis. Now, all of these issues have facilitated greater confidence in the ability of the euro to avoid the crisis to the extent that it had during the last crisis. But that doesn't mean that important vulnerabilities are gone. There's still a concern, and these concerns have been validated by the way that the Eurozone has navigated out of this crisis, about the extent of the willingness of states to truly cooperate. And when one country goes down, which affects the Eurozone as a whole, and it affects the value of the euro currency, domestic politics and self-interest still reign.
Now, what about the connection between Europe and the rest of the world? ECB is just one relevant player here. You mentioned the G20, you mentioned the IMF, and so on. How are the other parts of this complicated machine reacting now in contrast to the period of the last economic crisis?
Now, in terms of how all the mechanisms are working together, there was a sense that at the height of the crisis that G20 members worked together very well to pursue cooperative fiscal policy as well as monetary policy to respond to the sharp shock to the global economic system. But that cooperation has now waned. There were big concerns surrounding the impact of the Fed's decision to end the taper, as they call it, or end quantitative easing, which had immense impacts on emerging economies, in which capital all of a sudden flew out of those economies back to the United States in a search for safety, and on the anticipated future interest rate policies of the Federal Reserve. Now, what this indicates is a core issue within the global economic system, which is how will states cooperate when facing a crisis and when facing global economic imbalances. Now, the G20 was considerably helpful during the crisis, but as I said, as we got further and further away from the crisis, that cooperation began to wane. Now, we don't know the extent to which cooperation will be facilitated in the future through the G20, whether it be through the IMF, whether it be through the Financial Stability Board in terms of regulatory measures, but there has been a relative decentralization of that process, and the lack of confidence in facilitating cooperation is a key concern.
What about China, the role of China? There's some view that China actually weathered the last crisis fairly well and have pulled the global economy through it to some extent, thanks to persistent high growth rates. And China recently has been proposing creating its own alternative to the US-centric global economic or financial system. What do your survey respondents say about China and Chinese innovations? Are these threats to the stability and coherence of the governance of the international economy, or are these productive steps in the direction of greater resilience?
Yeah, a key outcome this year, which is of interest, was the creation of the BRICS Bank, which was portrayed as an alternative to the Bretton Woods institutions such as the IMF, to act as a global lender of last resort, to act as a source of liquidity during tough times. Now, despite all the fanfare surrounding this announcement, the truth is that if you look in closely at the nature of the BRICS Bank and the construction of the bank, it's quite clear that this isn't a true alternative to the Bretton Woods system. Now, this is, I would argue, and a number of our respondents highlighted, this is good for the international system, because the creation of an alternative that lays outside of the multilateral system creates a more fragmented and fractured international system.
Also, it's relatively small, isn't it? Relatively small capitalization.
Exactly. The level of commitment and the amount of money supplied to the institution just is completely insufficient to address a systemic crisis.
Another one of the topics you were addressing in your survey was financial regulation. Tell us a little bit about the nature of that problem and what your respondents said about it.
So this was the most positive outcome, with an average score of 45% from our respondents. And that optimism was primarily driven by the outcomes of the Basel III capital adequacy requirements. It was felt that, for a long time there have been immense negotiations surrounding the future of financial regulation and the trajectory of international financial standards, and that a number of respondents said that the key aspects of that system are starting to come to fruition now. And Basel III was really highlighted as a key outcome. Now, the respondents said that through Basel III capital standards that we will see a more resilient and a strengthened financial system by raising both the quality and the quantity of capital that banks are required to set aside to improve their solvency and to strengthen their balance sheets. Now, this was a positive outcome. However, there are a number of key vulnerabilities in the international financial regulatory system that are cause for concern for the next financial crisis. The lack of progress on the issue of shadow banking regulation was a key concern for respondents. The failure to establish an effective cross-border resolution regime for financial institutions was another cause for concern. And there was also a concern about the increasingly fractured international financial regulatory regime. Essentially, at the beginning of the crisis, there was a commitment to coordination and cooperation between states and their financial regulatory frameworks, and that's begun to decline. And what we've seen is that domestic politics is starting to take over, and that states are pursuing different financial regulatory frameworks, which is at odds with the global nature of finance.
What are some examples of that, just to illustrate this? Which countries are doing what in different directions?
Yeah, so a key friction has been between Europe and the United States on derivatives. OTC derivatives were a key cause of the last financial crisis and a key platform for reform afterwards. Now, there are a number of issues surrounding this, but the United States is introducing extraterritorial measures, which means that firms must be compliant with their financial regulation if any part of the business falls on their jurisdiction. Europe is providing a different, legal definition of what is a trade and what is a swap and all these sorts of issues. And that's a key tension because it means that rather than having consistent and coordinated regulation across borders, you're seeing fragments. And this may result in regulatory arbitrage, in which financial firms move their operations to jurisdictions with lower levels of financial regulation. But it also just might lead to deficits in supervision. We just don't see the risks as they emerge.
Is the main effect that it slows down capital transfer?
No, it's more. It may have the long-term impact of slowing down the level of transactions between jurisdictions, but the ultimate concern is that some trades just aren't seen.
Aren't seen at all.
Aren't seen at all.
They're under the radar. So transparency and accountability are big problems.
Yes.
Which presumably complicates monitoring.
Yes, exactly.
All right. So is that the particular angle that your respondents thought needed the most attention in the short term? The transparency, the monitoring, accountability? Yes.
Most of our respondents really highlighted the impact that this would have on cooperation and coordination between regulators across borders. There is a lot of money being transferred around the global financial system. Keeping track of that, identifying risks as they emerge, and providing information to each other so that regulators from foreign jurisdictions simply know what is going on in their borders and the potential risks that financial firms, either as the firm itself or as counterparties to other firms, pose to the stability of the financial system as a whole. Now, these may seem like small squabbles, but the truth is it could lead to a less cooperative environment.
It's interesting because you would think that law enforcement and counterterrorism and so on would be very strong incentives to iron out these inequalities in the regulatory frameworks.
You would, but we just haven't seen that.
Haven't seen it. That's very interesting. Another issue on the agenda of your survey was trade. So tell us, what's the state of the world as far as trade is concerned, according to your respondents?
Now, this was an interesting one because it provided, our respondents provided a relatively mixed assessment. And this was driven essentially by two outcomes. The lack of progress in the WTO over the past year, and particularly the Bali negotiations, and the lack of an outcome this year, and the inability of the WTO to tackle the core issues in this current round of talks meant that the respondents were a little bit concerned about the lack of progress in multilateral trade. But with that said, progress on trade has been moving through these regional and plurilateral mega trade deals. For instance, the Trans-Pacific Partnership, the recent trade deal conducted between Canada and Europe, for instance, and a number of others that have highlighted the efforts of states to reduce barriers to trade. But the interesting issue surrounding that is that if you see this rise of plurilateral and regional trade agreements and the failure to incorporate those within the WTO and the multilateral regime, there was a real concern that failing to incorporate those would create an increasingly fractured and fragmented trade system, which isn't good for the long-term prospects of trade and liberalizing trade.
Now, is the TPP an example of progress? I know there's been negotiation, but there is the cynical view that at the end of the day, we probably won't see much. If we actually see an agreement, it will be very restricted, full of exceptions, full of the predictable exceptions, some of the same dynamics that frustrated the next big WTO deal might undercut the TPP. What's your read on this?
The read of our respondents was that it is difficult to assess the level of progress that these agreements will have because of lack of disclosure, a lack of information surrounding the current state of these negotiations, the extent to which states are actually reaching agreement and making progress on key issues. Obviously there's a lot of discussion as to the extent to which it will truly make progress, but we simply don't know because these negotiations are currently happening in secret. Therefore, it's difficult to assess.
And is there a big difference between a global series of plurilateral agreements and a large number of bilateral agreements if in terms of content they're relatively similar?
There is a possibility that a number of agreements could all work towards the same cause and start to build progress towards the same aim, and that would be helpful. But the intention of the trade regime is to reduce the extent to which barriers of trade are being raised. Now, if some countries are left out of that regime, then there could be problems down the road.
And what's the next frontier in trade? Is it services, intellectual property, agriculture?
There have been a number of areas in which progress is seeking to be achieved, and it really runs the gamut of all of those issues. I know that agriculture was a key aspect of the trade agreement between the EU and Canada. However, there are other aspects in which financial services have been included in those agreements to the concern of many. So it is very varied. I don't know the extent to which you can say that there is a next frontier because there are many negotiations happening. Now, with that said, I think there's a feeling that if we were to make real progress on issues of agriculture, for instance, India was a key barrier to the Bali negotiations this year. And the effort of Canada to address the supply management regime in its negotiations with Europe, indicates that there is a severe focus or a real interest in agricultural issues. But the extent to which we'll see progress on that, again, we just don't know.
History wouldn't be optimistic.
No.
Another issue area you touched on in your survey was climate change.
Yeah. Now, this was the least optimistic. The lack of progress in international negotiations was a real cause for concern. Essentially, the extent of north-south collective action problems has really been at the heart of failing to achieve any progress on climate change. And our respondents simply didn't see much hope in any progress being on the horizon. Now, the only caveat to that was that there has been some important movements on the domestic front. You know, the Obama administration has made significant efforts to reduce its reliance on heavy GHG emission-based electricity. And furthermore, so has China. States are making significant efforts to try and reduce their total level of emissions, which at least signals that the public is starting to feel the impacts of climate change and that it is starting to accept the impact of that, which is creating momentum towards addressing these issues.
We don't often think of climate change, sorry to interrupt, we don't often think of it as an economic governance problem primarily. So when your survey respondents addressed it as an economic governance problem, what specifically were they focusing on? Were they focusing on the resilience of the global economy to pay for adaptation and mitigation? Were they focusing on the stranded asset problem and the carbon economy? Which were the particular issues where climate change intersects with economic governance?
I guess we didn't treat it as a specific economic issue that needs to be addressed, but we understand that the future effects of climate change will have an immense impact on the global economy. Maybe not today, but we understand that it's going to be a key issue in the governance of the global economy in the future. Therefore, the extent to which we've attained progress in this area was important to analyze and understand.
And the reason I ask that is because there are some recent reports that suggest that actually aggressively promoting cleaner energy will have economic benefits. That there would be a net win. And the jurisdictions, for example, that have carbon taxes tend to outperform jurisdictions that don't, and so on. Yeah. So maybe there's an opportunity here waiting in the wings.
No, definitely. And one of our fellows, Jason Thistlethwaite, is really interested in this issue in terms of the impact of climate change on risks to the financial system and in particular insurance companies. We truly understand the extent to which these organizations and private actors are truly concerned about the economic costs of climate change and see it not only as a risk to the environment and to the earth, but also to a risk to the stability of the financial system as a whole. The impact of climate change on insurance is going to be immense, as they're left out of pocket for billions of dollars when you have extreme weather events such as Hurricane Sandy and Hurricane Katrina. So there's definitely an awareness, and the interesting part of that for the results of the survey was that it was highlighted that non-state actors, in particular private financial actors, is undertaking some experimentation in terms of how to respond from the private side to reduce GHG emissions, or at least to disclose those who are heavily exposed to carbon-intensive sectors of the economy.
Very good. In the remaining time we have, which is short unfortunately because we could go on for a very long time, tell us a little bit about how CIGI envisions its own role, stepping back from all of these issues. Its mandate is governance innovation. Is there an opportunity here for governance innovation? Do you see that? Do your colleagues see that? Or at the moment, is it really just a question of trying to get a sense of the whole picture so that we can decide which particular levers to push as we move forward?
So the outcome of the survey really highlighted the extent to which the institutions that govern our global economy are insufficient to deal with the next great economic and financial crisis. And obviously, the whole focus of our research program and the focus of our work is to identify the key vulnerabilities in the international governance regime and identifying innovative solutions to address that. Now, for instance, sovereign debt resolution and sovereign debt restructuring has been a core focus of our work in the Global Economy Program, finding ways to create a more cooperative governance regime to the restructuring of sovereign debt. This is just one example of the ways in which we can innovate in the global system. Some other issues, for instance, is work on how international financial standard setting bodies can better do their jobs and better coordinate between domestic jurisdictions. So there's a lot of work ongoing.
Very good. Well, thanks for coming in and sharing your insights with us. And it's a fascinating study. This is something that will be done every year?
It will.
Very good. Well, we'll be curious to see how the progress tracks. Thank you to David, and thank you to our audience for joining us again this week on Inside the Issues. You can look for us at cgonline.org, on Facebook, on Twitter, and on YouTube.
The issues surrounding the Eurozone is a key risk to the currently fragile global economic recovery.
Which dimensions of international economic governance are you particularly concerned with at the moment?
So a key issue and a key concern was macroeconomic and financial cooperation. And the key issue that arose there was that the issues surrounding the Eurozone and the slow rate of return to growth, continuing issues around deflationary pressures in the Eurozone are having a real impact on the extent and the confidence of the global economic recovery. Now, what this highlights is that countries in Europe have failed to cooperate in their macroeconomic policies. Critically, those countries who have fiscal room to pursue expansionary policies that would stimulate consumption and stimulate growth are not doing so and continuing to consolidate.
Of an important recent policy brief and a participant in a major project on international economic governance. So welcome, David.
Thank you.
Welcome back, I should say. Let's begin by talking about this project you're doing, and in particular, a very interesting survey that CIGI does each year to gauge progress on international economic governance. Tell us what that's all about.
So it's a survey that we do annually, and the intention of the survey is to assess the level of progress that has been made in facilitating economic cooperation between states, focusing on the extent to which the G20 and other key international economic governance institutions have facilitated cooperation. And this year we sent it out to 21 of our fellows who provide a quantitative and qualitative assessment of the extent of progress that has been made. And the key finding from this year was that uneven economic growth, predominantly the expansionary fiscal policies that would stimulate growth and become an engine for growth that would get them out of this current malaise.
And what's the argument against them doing that?
Well, the argument against that is that what we need right now is consolidation for governments to reduce their total level expenditure and increase taxes to reduce the amount of debt that they have. Now, the problem, as we saw in Italy, is that when you consolidate your public finances, you try and reduce the amount of spending and increase taxes. The rate of economic growth slows down. Now, when the rate of economic growth slows down, so do the revenues coming into the government. Now, the impact of this in Italy was that despite the fact that it reduced its total level of spending, it actually declined in terms of economic growth, which meant that its level of public debt as a percentage was higher. Now, what this shows is that Europe needs pro-growth policies, their fiscal portfolio and public finances. Now, the issue with this is that those countries and those economies in the south of Europe who are struggling to consolidate their finances and public books, who need economic growth to achieve that, continually get themselves into trouble. And the inability to grow themselves out of public debt is a persistent issue within the Eurozone.
So what are the main cleavages here in Europe in particular? Is it a Northern Europe, Southern Europe split? Is it a France-Germany split? Mm-hmm. Is it a Britain versus everybody else split? What are the main dimensions of this lack of cooperation?
The main cleavages are between Northern Europe and Southern Europe. Countries such as Germany and Netherlands, who have always pursued conservative fiscal policies and have maintained conservative fiscal policies throughout the crisis, are unwilling to relent in allowing those countries in southern regions to pursue
on Inside the Issues, I speak with David Kempthorne on progress in international economic governance. Hello and welcome to this week's edition of Inside the Issues, a CIGI online podcast. I'm David Welch, CIGI Chair of Global Security at the Balsley School of International Affairs and Senior Fellow here at the Center for International Governance Innovation. And it's my pleasure every week to welcome a guest into the studios at CIGI to discuss some important issue on the international agenda. And today I'm very pleased to welcome David Kempthorne, who is a research fellow in the Global Economy program here at CIGI and a co-author